Although Nvidia's most recent earnings were unquestionably impressive, the stock's response said otherwise. Following an early spike, the gains subsided and the shares returned to their pre-earnings levels, a common pattern that emerges once the headline figures have been completely taken into account. Additionally, a mega-cap's trading range may narrow as it enters a post-catalyst period. Investors who wish to stay long and earn premium through a covered call strategy may find the outdated upside calls especially alluring in this market. Nvidia's stock momentum declines. Despite strong earnings, Nvidia exceeded Wall Street expectations with yet another impressive quarter. Revenue for fiscal quarter 3 was $57 billion, far exceeding the consensus of $54.9 billion. Additionally, adjusted earnings of $1.30 per share exceeded projections. Analysts had predicted $61.6 billion in Q4 revenue, but management guided it to roughly $65 billion, easily exceeding that amount. The growth engine was still the data center segment. Data center sales for Nvidia was $51.2 billion, a 66% increase over the previous year. Networking generated an additional $8.2 billion, while compute revenue totaled $43 billion. Blackwell's demand is still rising, and the company's CEO, Jensen Huang, reiterated that all of the big hyperscaler shads sold out of cloud GPUs. Nvidia is at the heart of one of the market's most robust multi-year investment cycles, as big tech companies have increased their capital spending forecasts for AI-related projects above $380 billion for the year. Additionally, margins improved. Nvidia closed the quarter with over $60 billion in cash and short-term investments, while it produced $23.8 billion in operating cash flow. Additionally, the business paid out $12.5 billion in dividends and buybacks to shareholders. The stock initially reacted as many had anticipated. Following the publication, Nvidia saw a 5% increase, rising close to $197 and edging closer to its 52-week high of $212. However, the strength was short-lived. By the end of November 20th, Nvidia had not only given up all of its post-earnings gain, but it had also fallen below the close of the previous day, closing at about $181. The same was true for the larger market. Nvidia's news caused the S&P 500 index to open strongly, up about 1.5%, but it fell precipitously into the close, closing down around 1.5%. Despite the season's volatility, the 3-point swing was notable. Things start to become intriguing at this point. Even for a firm this big, the market demonstrated how rapidly earnings news can be absorbed, despite Nvidia's fantastic numbers. Simply said, the enthusiasm that drove the stock higher in the first hour following the publication wasn't sustainable. Nvidia may settle into a smaller range until the next significant trigger occurs, since the most recent numbers and forecast are already completely priced in. Additionally, that change creates some very attractive positioning opportunities. Mega-cap stocks can experience a period of range-bound trading following a significant earnings event. This pattern has already been followed by Nvidia. The stock was trading around $182 per share after Nvidia's results release on August 27th. Although there was a lot of good news in the weeks that followed, the company's stock was only slightly higher by November 18th at $187 per share. Now, the stock has recovered toward $180 following a temporary price jump fueled by earnings. Selling upside calls becomes intriguing in that context. After an earnings event, near-term implied volatility frequently declines, but middle and long-dated futures typically retain a sizable premium. For instance, the IV rank for Nvidia's January 2027 options is close to 45%. When selling options 50%, that is just below the cutoff point that many short premium traders favor. However, one may argue that covered calls are different. They are more tactical in nature, particularly when the investor is trying to increase returns during a time when the upward trend may slow down and is managing an existing long position. This implies that volatility in absolute terms is less important. The January 2027 $270 calls are priced at about $15, resulting in a break-even point of about $285 per share, given that Nvidia is currently trading close to $181 per share. That exceeds the current stock price by more than $100. The break-even point for the January 2027 $300 calls, which are currently trading at $11, is close to $300 or almost $130 above current prices. These break-even points demonstrate to long-term holders how much space is left before assignment becomes an issue. For either strike to start capping gains, the stock would have to advance significantly. Short options traders can profit from a slow drop in implied volatility if Nvidia spends the following few months in a smaller range, as megacaps frequently do following a significant event. The decay of the short call can be supported by even a slight contraction in volatility, which could increase the combined position's return. Covered calls actually perform best in the following conditions: a stock that may be in consolidation mode, a little higher premium, and broad strike cushions. This strategy isn't meant to identify a peak or diminish Nvidia's long-term course. The basic plot is still the same. The point is that large-cap stocks frequently transition into calmer, more measured trading following a significant results event. Long-term holders can turn a slower period into a productive one by using covered calls, which fit neatly into that transition. Consider a long-term Nvidia shareholder with 1,000 shares who sells 5 of the January 2027 $270 calls to understand how this arrangement operates. The investor can still receive premiums from a long-dated expiration by selling calls against only half of the investment, which preserves some of the long exposure. Selling 5 futures earns roughly $7,500 because the $270 calls have been trading close to $15 lately. Regardless of the stock's performance, the investor retains the premium that was paid up front. The calls expire worthless if Nvidia increases during the course of the following year but stays below $270. The entire $7,500 premium and all 1,000 shares are retained by the investor. In addition to any gains from the underlying stock position, that premium is converted into additional yield. Since the stock performs well, and income is produced without lowering the long position, many covered call sellers see this as a beneficial situation. The conclusion is still positive if Nvidia trades above $270 by the beginning of 2027. From the present price of about $181 per share to the $270 strike price, the 500 shares linked to the short calls can increase in value by almost $90 per share before assignment becomes an issue. Since the remaining 500 shares are unprotected, they continue to gain from any additional rally. Additionally, the option's short premium is fully collected. Some investors could prefer that combination of realized gains, ongoing upside exposure, and collected premium over a straightforward long position. Even in the most extreme case, if Nvidia makes a strong comeback and pushes past the strike, the mechanisms remain the same. Half of the position's gains are capped at $270 by assignment, while the remaining 500 shares are still totally exposed to any further gains. However, the options premium still benefits the investor if Nvidia moves sideways or declines. By acting as a buffer, that $7,500 increases revenue and lessens negative movements. This is precisely why many long-term investors utilize covered calls during slower periods. The technique produces cash flow and smooths returns while the company awaits its next catalyst. When combined, these scenarios demonstrate how income, risk management, and ongoing upside can be balanced by selling 5 upside calls against a 1,000-share position. The trade gives Nvidia space to rise before the strike price is activated, while also capturing the high premiums that persist following a significant earnings event. This structure appeals to investors who wish to profit from a cooler, post-catalyst tape while remaining in line with Nvidia's long-term AI narrative. Not every trader will find the covered call in Nvidia appealing. While some want shorter durations or strikes that are closer to the money, others want unrestricted upside. However, the balance of risk and reward on an upward call sale naturally becomes more attractive when a mega cap like Nvidia runs out of stimulus and settles into a more stable rhythm. Furthermore, this dynamic is not exclusive to Nvidia. After the headlines subside, large cap stocks sometimes enter quieter periods, which frequently benefit investors who feel at ease trading around a long position. When the covered call structure is in line with the trader's outlook and the stock's tempo, it may be a useful tool, whether it's Nvidia following a later earnings beat or another heavyweight cooling off following a big run. Particularly after its impressive performance in the previous quarter, Nvidia is far ahead of its competitors, Advanced Micro Devices and Intel. Growth has been driven by the increasing demand for its Blackwell chips and cloud services, and there are now even more reasons to think about purchasing Nvidia stock. Let's investigate it. Nvidia dispelled any skepticism regarding its growth prospects with its strong fiscal third quarter 2026 results. Nvidia's reported $57 billion in revenue for the quarter was a 22% increase over the prior quarter and a 62% increase year over year. Its highly respected data center segment generated $51.2 billion in revenue, up 25% from the previous quarter and 66% from a year ago. Despite a 1% decrease from the previous quarter, its $4.3 billion in gaming revenues represent a 30% increase over the same period last year. Jensen Huang, the CEO of Nvidia, clarified that cloud graphics processing units, GPUs, are fully sold out and that data center profits were increased by the ongoing demand for Blackwell-based systems. Consequently, Nvidia's net income for the quarter rose from $19.31 billion in the same period, previous year, to $31.91 billion. However, Nvidia's confidence in continued growth is much more encouraging than its exceptional quarterly result. With a margin of plus or minus 2%, Nvidia projects that its fiscal fourth quarter 2026 revenues would total around $65 billion. Nvidia's supremacy in AI hardware and its robust competitive moat, which is strengthened by its CUDA software platform and is anticipated to continue driving its growth, are the main drivers of this optimism. Nvidia is a long-term investment for two other reasons. Wall Street is becoming increasingly concerned that the development in artificial intelligence, AI, could constitute a speculative bubble. Jensen Huang, however, has allayed those concerns by claiming that we have reached the positive AI cycle. With more new foundation model manufacturers, more AI companies, more industries, and more nations, the AI ecosystem is expanding quickly. AI is becoming ubiquitous and multifaceted. To put it briefly, Nvidia is in a strong position to gain from the increasing integration of AI into a wide range of applications. In addition, Nvidia's management is still highly optimistic about the company's potential for expansion and thinks it has a solid financial position. Through cash dividends and share buybacks, Nvidia has given $37 billion back to its stockholders since the beginning of fiscal 2026. Nvidia, an obvious choice. The stock becomes even more appealing after Nvidia's record-breaking third quarter due to its robust growth prospects, AI-driven momentum, and significant shareholder returns. Additionally, brokers are upbeat about Nvidia's future. The average short-term price objective for Nvidia stock is projected to be $239.49, which is a 28.4% gain from the most recent closing price of $186.52. $350 is the highest target, indicating an 87.7% possible increase. Additionally, Nvidia is less expensive than its competitors. The price-to-earnings (PE) ratio shows that Nvidia is trading at 40.33 times forward earnings, while the semiconductor general industry is trading at 45.92 times forward earnings. According to persons familiar with the situation, the Trump administration is thinking of approving sales of Nvidia's H200 artificial intelligence chips to China, since a bilateral detente increases the likelihood of exporting cutting-edge American technology to China. The sources emphasized that plans might change and stated that the Commerce Department, which is in charge of U.S. export restrictions, is considering changing its policy of prohibiting shipments of such chips to China. The administration is committed to securing America's global technology leadership and safeguarding our national security, a White House spokesman said, declining to comment. A request for comment was not answered by the Commerce Department. Nvidia stated that present regulations prevent the business from offering a competitive AI data center chip in China, leaving that enormous market to its quickly expanding international competitors. Nvidia did not immediately comment on the review. After U.S. President Donald Trump and Chinese leader Xi Jinping mediated a trade and tech war truce in Busan last month, the possibility suggests a more amicable approach to China. The Biden administration placed restrictions on such exports because China hawks in Washington are worried that supplies of more sophisticated AI chips to China would enable Beijing to bolster its military. Trump has threatened further restrictions on tech exports to China this year in response to Beijing's aggressive use of export curbs on rare earth minerals, which are essential for manufacturing a wide range of electronic products. However, in most cases, these restrictions have been scaled back. The H200 chip, which was introduced 2 years ago, can process data faster than its predecessor, the H100, since it contains additional high-bandwidth memory. It is thought to be twice as powerful as Nvidia's H20 chip, which is the most sophisticated AI semiconductor that can be lawfully sold to China after the Trump administration lifted its temporary ban on such sales earlier this year. Nvidia CEO Jensen Huang, whom Trump has called a great guy, was one of the visitors to the White House earlier this week, while Saudi Crown Prince Mohammed bin Salman was there. This week, the Commerce Department declared that it had authorized exports of up to 70,000 Nvidia Blackwell chips, the company's next-generation AI processor, to G42 in the United Arab Emirates and Humain in Saudi Arabia. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.